I'm going to share with you the number one strategy that I use to generate returns and profits on a daily basis. This is going to be a zero data expiration strategy. I'm going to show you everything step by step, from how to set it up, how to manage it, and what you can expect from it. Okay. This completely changed things for me. So of course, open SPX up. That's what we use to trade or to do zero data expiration trades. If your account is under $25,000 and you are subject to the PDT rule, you can make up to 3-day trades. So you can make 3-day trades in a rolling 5 business day period, and then you can switch over to something like /ES, which is basically the same thing as SPX, but it is just the futures equivalent. Okay, so that's a little workaround for anyone with an account under $25,000. So once you've got your list of expiration dates open, you obviously want to navigate over to the zero data expiration contract or expiration date, and you want to put this position on at the market open or within the first half an hour of the market being open. Okay, it's very important. And so what we're going to do is we're going to start off by selling a strangle. Okay, and we're going to sell a strangle at basically 20 deltas on either side. So we've got the 20 delta on the call side, 20 delta on the put side. And as you can see, we are kind of close to the expected move. You can, instead of using delta, you can use the edges of the expected move, like so. And you'll typically be able to collect a little bit more. If you want to be a little bit more conservative, you go with the 20 delta. But it just kind of depends on what the market's doing. There's no right or wrong. You're going to make money either way. It just sort of depends on what's happening in the market. If you just want to absolutely close your eyes and be mechanical about it, 20 delta is fine. If your broker doesn't display this expected move visibly here, as you can see with this vertical orange bar, if you look in the top right or somewhere in your broker, it will be displayed in parentheses an expected move, something similar. It looks similar to this, and it's usually next to your implied volatility. As you can see here, in parentheses, it's plus or minus 47.7 right now. That's our expected move. So you can just manually calculate it, plus or minus that off of the current price or the last traded price. So now that we got that out of the way, 20 delta strangle on either side, as you can see here. Market is moving slightly, and now you want to sell some wings, so we're going to turn this into an iron condor, and the sweet spot is sort of around the $20 wide mark. You want to be at least $10 wide, ideally at least $15 wide, and the wider you are, the more profitable you will be in terms of your average P&L per trade, although your buying power will increase. So if we start off with $10 on either side, I really would not recommend going any less than this. If you need to, go less than this because of your buying power restraints or whatever it might be, then you can, instead of using SPX, you can just use SPY. It's the exact same thing, but 10 times smaller. So this on SPY. We don't need to go into that. Basically, it's just 10 times smaller. Okay, so if SPX is too big for you, just do the exact same thing what I'm showing you here in SPY. And if you're using the futures equivalent /ES, you can use /MES, which is it's the same thing. SPX, SPY, ES, MES. It's all the same thing. They're just multiples of each other. So now that you have your setup like this, if in this scenario here, we'd collect 310 up front, and our buying power requirement would be 685. You can make it wider. For example, if you just double the width of the spreads here, as you can see, you're going to collect 550. You're going to put up 1.5, and you basically, the wider you go, the more money you're going to make per trade, but then also the more buying power that's going to be required per trade as well. So just keep that in mind, but you don't want to be any less than $10 wide, and as long as you're doing that, you'll be absolutely fine. Sort of around the $20 wide mark is the sort of sweet spot, but for smaller accounts, you might need to just stick with $10 or $15 or something like that. So our pop here is 61%. Now you're probably thinking that's lower than what we normally do, and you're right. But that's if we hold till expiration. So what we're going to do here is not hold till expiration, and we're going to actually get out early, a little bit earlier than normal, and we're going to get out at 25% of max profit. Okay. And if you put this position on at the market open and get out at 25% of max profit, you can just set a limit order. You're going to win about 90% of the time, a little bit more than 90% of the time. Okay. But for the sake of simple numbers, you're going to win 9 out of 10 trades. Okay. And the wider you go, that percentage will creep up little by little, the wider you make your wings. So you're going to win almost every single trade. You're going to get paid very well up front, and you are putting up a healthy amount of buying power. But this is a very consistent strategy because of the win rate. And especially in times like this where the IV rank is so high at 55, this is a very profitable strategy. If we have a look at the VIX 1 day, as you can see, it's 24 right now. Anything over 12 is really good for 0 day to expiration trades. So we're at 24 right now. So, great 0 day to expiration environments. If you're on the selling side of things, if you're short, or you're collecting a premium or a credit. So you do also need to keep your buying power in check. So we've gone over how to enter, when to enter, how to exit. And now you need to keep your buying power in check. So as you can see here, this requires $700 in buying power. And in order to keep your buying power in check, we have got a free position sizing template here. The link is in the description. Just click the button and it will take you over to this spreadsheet. And it's going to look like this. And the way it works is you enter in the size of your portfolio, and then you enter in whatever the current VIX level is at the time of whenever you're filling this out. And it's going to go over how exactly you should structure your portfolio and how much buying power you should be allocating to different types of positions, whether that is defined risk or undefined risk. The position that we went over today is an example of a defined risk position. And in this example portfolio, you can allocate up to $2,500 per position based on the current portfolio size and volatility in the market. So $700 is absolutely fine, and we would be able to put this position on. In fact, we'd be able to actually widen the wings out a little bit more, and we'd be able to, sort of put something on that looks a little bit like this. This would probably be a more suitable position. This is also, these numbers, keep in mind, these are the maximum. This is the maximum amount of buying power, and you don't have to use the maximum. In fact, I wouldn't recommend using the maximum. You don't need to be super aggressive. You can find another opportunity somewhere else. Lots of small positions is better than small big positions. Okay, so use this. Get a copy of this. Use it, and you'll be absolutely fine over the long run. If you do want to learn in more detail about what we do and how we do it, click on EDS Premium and get yourself signed up. Once you're inside, you will have access to this exact portfolio that I'm showing you here. This is a very small portfolio. It's deliberately small so that any positions that go on in this portfolio, it doesn't matter what size account you have, I can almost guarantee it's probably not going to be smaller than what this account is. So if you can put it in this account, then you can put it in your account. And if you have a larger account, then it's easier to scale up than having to scale down in this game. So that's why we've done it like that, and you will have access to all of our positions, all of our management, all of our adjustments, everything in real time. There's a full course as well, so no prior knowledge is required. We'll teach you everything that you need to know from start to finish, and it's a private community. So if you get stuck, you can speak with myself, you can speak with other like-minded individuals that are already inside, and there's a 100% money-back guarantee. So after 6 months of being inside, if you gone through the course and followed some of our trades and you don't know what you're doing and you're not profitable, then we will work with you for free until you are, or you can just request a full refund. So it is completely risk-free, and it's $9.99 a month to join. The price will be increasing, but once you're in, the price is locked in for you for life. So you are rewarded for getting in early, and the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill, and once you've learned it, no one can take it from you. It is a very powerful thing to learn, and we aim to get you to the point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.